Every single number in accounting follows an invisible rule, a rule that tells us what to record, when to record it, and how to present it. Without these rules, financial statements would be chaos, and no business would know if it's winning or failing. In this video, you'll finally understand the principles and assumptions that form the foundation of all accounting, not in theory, but in the real-world way professionals actually use them. Accounting principles and assumptions are the foundation of financial reporting around the world. Whether you're following GAAP in the US or IFRS internationally, principles are the core rules. They guide how financial information should be recorded, reported, and interpreted. Assumptions are the ground rules we accept as true, like assuming the business will keep operating, or that it has its own separate identity from the owner. Together, they create consistency, trust, and comparability in financial reports, so users, anywhere in the world, can rely on what they see. Let's dive into the 10 core accounting principles, the essential rules that keep financial records consistent, trustworthy, and comparable. These form the backbone of both GAAP and IFRS, and every accounting system builds on them. 1. Revenue recognition principle. This principle says, record revenue when it's earned, not when cash is received. For example, if you complete a service in September but get paid in October, you still record the income in September. This keeps financial statements aligned with when value was actually delivered. 2. Matching principle. Expenses should be recorded in the same period as the revenue they helped earn. If you buy inventory in June and sell it in July, the cost is recorded in July, not when you paid for it. This gives a clearer picture of actual profit in that period. 3. Historical cost principle. Assets should be recorded at their original purchase price, not their current market value. So if you buy a building for $500,000, it stays on the books at $500,000, even if its value doubles. Why? Because cost is objective and verifiable. Value can change and vary. 4. Full disclosure principle. Financial statements should include all important details that might affect decisions. This often means adding notes to explain things like lawsuits, lease obligations, or changes in accounting methods. Transparency builds trust and reduces surprises for investors and regulators. 5. Objectivity principle. Every entry must be based on solid evidence, like receipts, contracts, or invoices. This avoids bias or guesswork and keeps your records accurate and credible. 6. Consistency principle. Once you choose an accounting method, like depreciation or inventory valuation, stick with it. This makes it easier to compare results from one period to the next. If you need to change your method, you must clearly explain why. 7. Materiality principle. Focus only on information big enough to matter. Minor errors or tiny expenses that won't affect decisions can be skipped or simplified. Example: if a $5 pen is missing from a $5 million budget, it's not worth an investigation. 8. Conservatism principle. When faced with uncertainty, play it safe. Choose the option that results in lower profits or asset values, not the more optimistic one. This avoids overstating success and prepares businesses for potential losses. 9. Monetary unit principle. Only record things that can be measured in money. Employee satisfaction? Important, but not measurable in dollars, so it's not in the books. This keeps the focus on quantifiable financial data. 10. Time period principle. Financial performance should be reported over consistent, regular intervals, like months, quarters, or years. This helps businesses track trends, compare performance, and stay compliant with tax and audit rules. These 10 principles are the invisible rails that guide financial reporting. Whether you're in the US, India, Europe, or Australia, they help ensure that accounting remains clear, comparable, and grounded in reality. Now that we've covered the core principles, let's look at the 5 key accounting assumptions. The ideas we accept as true before we even start recording a single number. These assumptions are the foundation of how we think about business transactions. 1. Economic entity assumption. This means the business is treated as separate from its owners. Even if you're a sole trader, your business finances and personal finances are not the same. The records should reflect only the activity of the business, not the owner's groceries or rent. 2. Going concern assumption. We assume the business will keep operating into the foreseeable future. This allows us to spread expenses over time and avoid marking everything at liquidation value. Unless there's real evidence the business is shutting down, we treat it as continuing. 3. Accrual assumption. Under this assumption, we record revenues and expenses when they happen, not when cash moves. If you earn income in December but get paid in January, it still belongs in December. This gives a truer picture of what was really earned or spent in that period. 4. Stable monetary unit assumption. We assume that the value of money stays stable over time, even though inflation exists. This lets us add numbers from different periods without adjusting for price changes. It's a simplification, but it keeps financial reporting practical. 5. Periodicity assumption. We assume business activities can be divided into consistent time periods, like months, quarters, or years. This lets us prepare income statements and track progress regularly, instead of waiting until the business ends. Together, these 5 assumptions let accountants create consistent, comparable, and trustworthy reports, no matter where you are in the world. So why do all these principles and assumptions actually matter? Because they prevent confusion, and more importantly, manipulation. They make sure that financial reports are consistent, clear, and reliable, no matter who prepares them or where they're reviewed. Without this framework, reports could be twisted to hide losses, inflate profits, or mislead investors. These rules make financial data comparable across companies, audit-ready, and trustworthy for everyone, from small business owners to global investors. Banks use them to decide on loans, investors use them to place bets on growth, and managers rely on them to make strategic decisions. It's not just about being correct. It's about creating a system that everyone can trust. Many students struggle with accounting principles and assumptions, not because they're hard, but because they overlook the big picture. First, memorizing the list without understanding the logic behind it. Knowing that revenue must be recorded when earned is great, but if you don't know why, it won't stick. Second, mixing up principles and assumptions. Remember, principles are rules we follow when preparing reports. Assumptions are the foundation, the ground we stand on before we even begin. Third, ignoring how they show up in real business. Every invoice, payroll, or sales report is built on these rules. If you don't see the connection, accounting can feel abstract and pointless. And finally, not applying the conservatism principle properly. Students often overestimate values, forgetting that in accounting, we favor caution over guesswork. Avoiding these mistakes will help you build a rock-solid foundation, not just for exams, but for your entire accounting career. These principles and assumptions aren't just theory. They guide every real-world transaction. Accountants use them daily when recording sales, expenses, payroll, or adjusting entries. Auditors check whether a company followed these rules. If not, that's a red flag. Even small businesses follow them, often through software like QuickBooks, Xero, or Tally, which are built on these standards. And here's the bonus. These principles lead directly into everything you learn next. Adjusting entries, trial balance, financial statements. Once you understand these rules, everything else becomes easier. Accounting doesn't work without rules. These principles and assumptions are the rules, the foundation. Master them, and you'll make sense of everything from simple sales to complex audits. If this video helped make things clearer, hit like, subscribe, and drop a comment if you want a full video walking through real transactions that apply every one of these principles in action. Let's keep building your accounting confidence, one concept at a time.